Okay, again, everyone, thank you very much for joining with us today. We will be covering small business plans and how to self-direct those. My name is Alex Perny. I am with Advanta IRA. I've been here since 2012. I previously worked as an account manager doing dedicated account management for clients and actually handling investments and plans throughout the beginning part of my career, but I've been doing education and development here for the past several years and have really enjoyed it. So if anyone does have any questions, again, whether it's on the functional deployment or more on just how these things actually function, again, please do feel free to reach out to me directly. Advanta IRA and our employees, we do not provide any investment advice, nor do we endorse or promote any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. And that's especially important, the topic at hand today, because the type of plan that you choose is going to have very specific consequences for you as far as tax planning goes. Specifically on how you take deductions, how things are contributed to the plans, which one is going to make the most sense for you from a tax planning perspective. These are all very important questions that really need to be addressed before making the determination as to whether or not you want to do something like a SEP IRA versus a simple IRA versus a solo 401k, or maybe just using an IRA. Again, all these things have very important consequences when it comes to what is actually going to be the perceived benefit to you as the small business owner. So do keep that in mind when you are kind of making the decision to pick a plan that some of this stuff does bear a little bit more on the side of needing to get some actual advice when it comes to making a decision. Advanta IRA, a little bit about us. We're a self-directed retirement plan administrator. We serve clients worldwide. We have over 20 years of industry experience. Definitely need to update that slide a little bit. We were founded back in 2003, so we're very proud of the fact that we've been doing specifically just this for small business owners and individuals for investing in alternative assets and how to kind of think a little bit differently than what you might be just provided by your larger wirehouses and other financial information out in the marketplace. So again, we're very entrenched in this particular type of investment structures and these plans. We administer over $3 billion worth of capital for our clients, specifically in alternative assets through small business plans, through IRAs. So if you do have any questions, again, we are more than happy to help out with that and try to get you the best information possible. And every account here at Advanta, if you do decide to do something with a small business plan, has dedicated account management. We have singular points of contact for anyone that is, looking to utilize our service. It's not like you're ever going to be calling a phone bank. You have great webinars. You have great counterpoints on the other side of the equation to help you out with all of these decisions, which can be a bit garrulous at times. Although we're not necessarily going to cover a ton about the different investment types, it's more going to be on plan choice and what that kind of looks like. I do like to always make sure I elucidate to specifically what you can do with these plans, because it's all well and good to say, hey, look, I can do a small business plan. I can, establish this, I can contribute money to it, but just putting money into a bank account really is the small end of the equation, right? It's how you can invest and grow these things. And while that certainly is important to understand, again, not necessarily a focus here today, but understanding, especially with the alternative space, there are a lot of options. We deal a lot in real estate and in real estate debt, but private placements, precious metals, foreign currency, futures trading, all sorts of different stuff can be an option for you as the client if you like to go this route. And a lot of people are kind of under the impression that this is new or different. It's just a very small segment of the marketplace. But when you talk about small segments, when the retirement plan umbrella in the United States has roughly $37 trillion in it, even 4% of that is a very large amount of capital. So understanding that the IRS kind of leaves it up to you as the individual to determine how you'd like to invest this or which direction you'd like to go with it is very important. And again, we're here to help kind of guide you and make sure you understand, exactly, what are the options out there for you in relation to these. And why choosing a small business plan? Again, it can be a new source of capital for, that provides you with the needed capital for an investment. If you're tired of the stock market fatigue and kind of that roller coaster ride of going through all of that, that can certainly be another big benefit. And the tax benefit, which is really kind of what that we are going to be focusing on today is the higher contribution limits and the additional record keeping, in the addition of record keeping options for you. So these are some really important things to understand of why people might want to go one way versus the other, and the tax benefit is really going to what we're going to focus on, as well as the higher contribution limits associated with these plans. So again, some great information coming shortly. Now, the self-directed kind of plans that are out there, again, just to understand that there is a large spectrum of them that you can do. Again, we're going to be focusing on the SEP IRA, the simple IRA, and the individual 401k plan today. But again, any of these types of plans can be self-directed that are up on your screen right now. Everything from a traditional to a Roth, health savings, education savings plans, all of these things can be self-directed. It's not simply just Roth IRAs. For whatever reason, and I have no idea where this kind of came in to the kind of general thought construct surrounding self-directed plans, is that you have to have a Roth plan to do it. That's certainly not the case. There are many different options for you out there. And again, it's just understanding which one is going to work best for you, which is kind of what we're aiming to provide to you today. So understanding qualified plan or IRA. Now, when I talk about a qualified plan, specifically, we're going to be talking about, or I'm referring to, solo 401ks. You know, what is that? What are some of the differences between those and the IRA type plans, which are the SEP IRA, which is the simplified employer pension, or the simple IRA, which is the savings incentive match for employers. That is the three main basic types of small business plans. Now, I certainly kind of do skew towards liking the solo 401k a little bit better than the rest, but they all certainly do have their place. And we're going to kind of really illustrate as to, you know, maybe why I have the thoughts I do on the solo 401k. Again, very powerful plan, a little bit more complex than other ones, but if you can kind of wade through the complexity, and again, complexity is, you know, it can be a little bit to understand it on the very beginning, but when you start seeing exactly how much money you can get into these plans, it is, again, going to be very powerful. But again, nothing's without its drawbacks. So some of the inherent differences between them are, you know, making sure you understand which one you might choose and why. So which one should you go with? Well, a 401k, there's no special discrimination testing for owner-only businesses. And I am specific when I'm saying owner-operated businesses, because 401ks, as we'll get to in the next slide, are going to have a significant increase in price and complexity the second you start having rank and file or common law employees. And we'll define that in a minute as well. Now, SEP simple IRAs, you can cover up to 100 employees with a simple IRA. SEP plans can have any number of employees, and the administration options for SEP and simple IRAs are varied. You know, you can have a SEP IRA at one firm, and then you as the business owner can have your SEP IRA at Advanta doing alternative assets, and you don't have that kind of fiduciary issue to the most part that you might have with, excuse me, with something like a 401k where it's a trustee-driven plan. I do see someone that says they have no, they can't hear the odd, oh, actually, it looks like they got it figured out. Okay, great. So again, understanding which one might work better for you. Again, the solo 401k, inherent in its name, really works well for owner-operated or spousally operated businesses, meaning if it's you and your spouse, you know, you're the owner-operators of the business, you can kind of look at it as one and the same. It's once you start having, again, a rank and file employee, someone on the payroll. And again, you can, if you have a true independent contractor where you're not, you know, keeping them on the books, you're just, you know, doing that. You know, that's something maybe to ask a CPA to say, hey, you know, do they qualify in any way to be covered underneath my plan? If you have a solo 401k, again, there's a lot more kind of research if you have employees of the business as to whether or not the 401k is going to be a viable option for you. But again, at a high level, 401ks, especially the solo 401k, work exceedingly well for the owner-operated business. If you have employees, maybe something like a SEP or a simple IRA might work a little bit better and be a little bit more cost-effective with the consideration of having employees for the business. Now, IRAs can accept, or the SEP and simple IRAs can accept rollovers from other retirement plans. So anything that's pre-tax can roll into a SEP IRA and a simple IRA, especially, and also a solo 401k. The funding options don't just start from the genesis of the plan. You can roll over funds into one of these types of plans from an external source. So if you have a traditional IRA or an old 401k, you can use that via a rollover, a direct rollover into a solo 401k or a SEP IRA or a simple IRA. These things don't have to have been in existence prior to this. They can transport in relatively easily. Now, impacts of other employees. So I intentionally kind of spoke about the impacts of other employees because it does really kind of throw a wrench in the system if you do have other employees and you want to use a solo 401k, because the short of it is you really can't use a solo 401k. You have to have something like a safe harbor plan, which would allow for additional employees to be covered, but it also does increase your cost quite significantly as well. So what types of employees can be excluded from an employer-based plan? Individuals under 21, non-resident aliens, and union employees covered by collective bargaining agreements. So if you have anyone working for you that is covered or is falling under one of those categories, they can be excluded from the plan. Now, I don't say that for the intent that people should be going out there and intentionally trying to exclude people, but it is important to understand from a very practical perspective who you actually have to or are required to offer these types of plans to. So again, take it for what it's worth, but it's important to understand who is going to be considered a covered employee and who is not at a very high level. Now, what types of employees must be included? Well, with a solo 401k, it's going to be anyone that's deemed to be a common law or a regular employee. So those who have worked at least 1,000 hours per year in a given year, or 500 hours a year for 3 consecutive years. Those definitions changed back in 2018. So again, if you were thinking back a little bit farther, again, most people in this are, a little bit older enough to at least have remembered what the previous definitions of an employee are. But in the past 5 years, those definitions by the Department of Labor have been updated. And specifically, that does have to do with a solo 401k. So with a SEP IRA, you have to include anyone who has worked at least 3 of the past 5 years in a capacity that does meet the same one for the solo 401k. And then simple IRAs are even a little bit different in that you have to include anyone who has received at least $5,000 in compensation during either of the last 2 years. So the IRS is nothing but fun when it comes to having rules. It's kind of what the whole system is built on, and understanding, especially in the context of small business plans, what that means for you is very important when it comes to determining, what you are actually going to be who you're actually going to have to be covering in this scenario. So again, high level, those are some considerations that might help drive which plan that you would actually like to use. So now let's look at it from the perspective of someone making $100,000. Which one is going to be the most effective for that person in determining what their contributions look like? And this really does help to illustrate why, at least for me personally, I like the solo 401k if it works for people, because dollar for dollar, it's going to allow a significantly higher amount of money to be contributed into the plan than you otherwise would be under other small business plans. So what does that look like? So with a simple IRA, here's what it looks like. So John is a sole proprietor, so in 2024 made $100,000. Which plan is right for John? Well, in a simple IRA, he could make a total of a $19,500 contribution to the plan. Now that's broken down further into a $16,000 salary deferral, which is the max under a simple IRA. And he could certainly contribute less if he wanted to, but we're going to go in the assumption that he wants to maximize his contribution limits to this plan. So under a simple IRA, he could contribute $19,500, which is constituent of $16,000 of salary deferral, so what he's deferring out of his compensation, plus $3,500 from the employer match. Now, another reason why it's very important to get with a competent CPA or tax advisor is that, especially if you're a self-employed individual, when I say something like an employer match, most people scratch their head a bit and you're saying, well, I work for myself. It's all just going into one bucket, especially if you file, let's say, as a subchapter S, you're not filing as an LLC partnership with one person typically. How do those kind of delineate? Well, again, looking at which one might be considered the number for calculating that, it might just be the NOI, which would be your total compensation for the given year anyway. So again, not to get too far in the weeds, but understanding kind of which number to use is important, and ultimately that's going to be a determination for a CPA to make. In this example, we're going on $100,000 is the number that is going to be at the end of the road by saying, hey, look, this is the total comp. This is constituent of how much the business made and also how much the individual is earning for calculating contributions. So again, the simple IRA, $16,000 of salary deferral plus a $3,500 employer match. Now the SEP IRA is extremely simple. It is 25% of compensation, not to exceed a certain contribution threshold. So the SEP IRA contribution in this scenario is going to be $25,000. 100,000 bucks times 0.25 gives you 25 grand. And that is going to be made as a deductible contribution. And some people might be aware that the IRS did, or our government did write into effect under the Secure Act 2.0 the ability to have after-tax contributions to SEP plans, but we'll get into why that's not the case yet for people. So again, the SEP IRA and the Simple IRA both, in theory, could be after-tax Roth accounts, but as of right now, and we'll get into the reasoning behind that, is that, excuse me, you can only do them pre-tax, so it is going to be a deductible contribution. So for the solo 401k, you can contribute up to $48,000. Well, that's almost double what you can do from a SEP. Same amount of money earned, just different plan types. So you can really see how the amount of money scales up from starting at the simple IRA, going to the SEP, and ending at the solo 401k. So for the same amount of money earned, almost double the contribution limit. Well, the solo 401k, just like with the simple IRA, is broken down into two buckets. You have an employer match and you have a salary deferral. So for this, John can contribute $23,000 of his salary into the plan. Again, that's the maximum contribution limit for someone under the age of 50 and a half. So he can, in this case, just contribute 23 grand to the plan. And with a solo 401k, the cool thing is that can either be deductible or non-deductible. So he can make either a $23,000 traditional contribution to the plan, or he can make a $23,000 Roth contribution to the plan. And this has been in effect and legislated. Again, you've been able to have a Roth 401k for many, many years. I believe it goes back to 2005, if my memory serves correct. So very well established, you can absolutely do a Roth 401k. And then the other part of that contribution is the $25,000 employer match, which can be up to 25% of the net operating income of the business, not to exceed a total plan contribution limit of up to about $73,000 or $76,000 or $69,000 roughly, depending on your age. Now, for all three different types of plans, you might have the potential to have a catch-up contribution. Now, with a simple IRA, you get an additional $3,500 of salary deferral. So in that case with John, that means he could contribute up to $23,000 to that plan, if he was over the age of 50 in that case. Now, with a SEP IRA, no catch-up contribution. There just isn't a catch-up contribution provision. With the solo 401k, you get an additional $7,500 of salary deferral that you can put into the plan per year, with a individual over the age of 50 and a half. So those are kind of, again, for a practical application of how these plans work, which with most people is what they're looking for, of saying, hey, where the rubber meets the road, where exactly do I make that determination? That's kind of how it plays out with someone that makes $100,000 a year. So what are some of the advantages? Again, with a 401k, you have higher funding limits. So the amount of money that you can put into the plan for the same amount of money earned is going to be higher. It's just going to inherently be higher for a 401k. You can defer a larger amount of the income on different buckets. So whereas with the SEP IRA, you can only contribute 25% of your compensation. So you would have to make considerably more money for those calculations to work to get up to the same level of contribution as a 401k. You do have larger starting points for how much money you want to contribute. And although I do always kind of use the round figures of the maximum contribution, you don't have to do that. You can use, you can contribute a little, you can contribute a lot, you can do none one year and as much as you can the next year. You're under no obligation for a SEP and a solo 401k to maintain your contribution levels from year to year. However, with a simple IRA, you are. So keep that in mind, again, helping to make some determinations. Additional benefits of the solo 401k is that you have access to tax-free loans. You can actually borrow money from the 401k up to $50,000 from that plan, depending on how much value that you have in that plan. You have the ability to escape unrelated debt finance, which is a part of the UBIT tax code for investing in leveraged real estate investments. And you have some pretty cost-effective options depending on how you actually want to administer the plan. A lot of people have heard of the term checkbook control. Again, no IRA has built-in checkbook control, but with a solo 401k, you do potentially have the option to do checkbook control directly with the plan, which we'll cover in a moment. And you also do have currently established and are able to do a Roth 401k. So with a solo 401k, you have two different options basically on how you administer it. I know I'm spending quite a bit of time on the solo 401k, but again, there's really not a whole lot of additional information that goes into the SEP or the SIMPLE when it comes to the administration. Covering the contribution limits is really kind of the big key in the SEP and the SIMPLE IRAs. They are IRAs, so they have to have a custodian. So you don't necessarily get direct access to the checkbook unless you want to set up like a subsequent LLC or something. The contribution limits, again, are going to be very easy to calculate, 25% of income with a SEP, and then you also have the employer contribution up to 3% or 3.5% of the total comp, plus the $16,000 of salary deferral to that plan. So again, very simple, and that's kind of the reason why, again, I just don't cover a whole lot else, because there really isn't a ton else to do. With the solo 401k, it bears a lot more explanation because there are several different options on how you do this. And one thing that people do tend to gravitate towards is the concept of checkbook control, being able to write checks directly out of the retirement plan to do everything themselves. And the solo 401k is the only plan that options that degree of flexibility when it comes to administering the assets. So with a solo 401k, you can do something very similar to an IRA, where you engage the plan administrator to do the record keeping, to hold the cash, to review the investment documents, to again keep record of everything going on. You can certainly do that, which is very analogous to what a IRA would be. So think self-directed traditional, Roth, SEP, SIMPLE, all very similar. But with a solo 401k, in that it is a trustee-driven plan, you can do it all yourself. So the DYO, or the do your own option that John might choose in this scenario, is that he could administer everything himself if he wanted to. So he could act as the trustee, he could sign all the documents, and he does sign all the documents in both models. But in the DYO plan, he does all of the record keeping. He uses, if he wants to use a third-party administrator, he can, but if he doesn't, he could have a trust account external from Advanta that would be under the name of the plan. We wouldn't have any direct access to it. He would write all the checks from it and go forward from there. So you could either run them kind of like an IRA if you don't really like to do the record keeping or the bookkeeping of the plan, or you could run it more as a checkbook control scenario where you as the plan trustee have your own trust account that's set up. You do everything yourself and just go forward from there. Again, really powerful tool that people don't necessarily realize can be built into a solo 401k. And again, another reason why I really like these types of plans. So we have some additional updates that have come out in the tax law that are important with regard to SEP IRAs, simple IRAs, solo 401ks that I like to cover, because the concept of using one versus the other, again, I think we kind of covered pretty well. Again, it's just kind of determining, whether or not for a certain given amount of money, how much complexity you want, and whether or not you really would like to have an after-tax option for the plan. So beginning back in 2023, we had the initial bump of your contribution limits for traditional and Roth IRAs going up to $7,000 and $8,000 respectively. Now, an additional option that might be of interest to people, especially if you are going the more IRA route with things, is that beginning in 2025, individuals age 60 to 63 can contribute an additional $10,000 per year per person. So beginning in next year, with higher contribution limits to traditional and potentially Roth IRAs for those older individuals, it could potentially kind of skew which one makes more sense. Again, the 401k with its additional complexity, or just going the IRA route, depending on what your short-term goals are, especially if you're a self-employed individual. If you're making over $145,000 per year, those additional $10,000 a year payments to an IRA have to be made after tax. So some people, when I've been talking to people over the past year, have thought, oh, well, the 401k makes a lot of sense because it has that Roth option and with the additional amount that you can get in there. But looking at it from the perspective of saying, well, if I make over a certain amount of money, now I can already get, potentially with a married couple, get an additional $20,000 into a Roth IRA. Again, that might skew move the needle a little bit as to which option really kind of resonates with you a little bit more. And beginning in 2024, the annual SEP Simple IRA limit and the catch-up contribution increased by 10%. So this year we had a 10% increase for employers who have no more than 25 employees. So for the smaller end of the spectrum of the small business owner, you got an increase of 10% to your annual contribution limits. Employers with 26 to 100 employees will have the ability to offer higher deferral limits, provided that the employer gives 4% match to the employee's deferral contribution or a 3% employer contribution. I know that's kind of a lot, especially for a plan named Simple IRA. But again, I find it a very disingenuous name for that plan, because simple IRAs are very kind of antithetical to how easy most of the other stuff is to comprehend from a high level, at least in my opinion. So again, that's just kind of some of the stuff that we're seeing as far as an update nature coming into the new year, starting in 2023, some coming in 2025, and then some coming this year as well. So I had mentioned in the beginning of this, at least, that there were some things to look at from the perspective of saying, oh, well, you might have heard that there's a Roth SEP IRA or a Roth Simple IRA. And while in theory, there is, beginning January 1 of 2023, which now we are in the beginning to middle of September of 2024, you were able to have them. The IRS has still not written the reporting codes for us as custodians to be actually able to offer that service to our clients. So while in theory, you could have an after-tax SEP IRA. So in that example I gave in the beginning where John had $100,000, well, that $25,000 that he contributed to that plan has to be tax deductible. It has to be after tax. It has to be before tax. Again, in theory, you should be able to do it into a Roth SEP IRA or a Roth Simple IRA, but we still don't have the ability to report that correctly to the IRS. So it's a form over function kind of issue. We just do not have the ability as the custodian of the account to offer that account type to people right now. So depending on what your current needs are, the solo 401k really is the option that's going to give you the large Roth or after-tax contribution limits that some people might really be looking for. Again, so back in 2023 is when we got that, but still, as of September of 24, we don't have a functional way to offer the after-tax contributions to SEP and Simple IRAs. The solo 401k is still the only one that directly offers that to people. Another update that we got is, especially in the context of understanding how to get more Roth funds into a Roth IRA, unused 529 college savings 529 funds can be rolled into a Roth IRA if the plan's over 15 years old. So especially for those of you that are small business owners, you probably are, especially if you have, especially if you have children, probably utilized a lot of the different tax savings accounts out there. So if you do have an unused 529, I'd just like to include that as, it's kind of some well-rounded information. I think it's good for people to have. So beginning in the 2023-2024 years, we have some additional 401k changes and improvements that have come along as well. So again, mostly what we've covered today has been focused on the owner-operated plan. So you don't initially have to worry about employees. But let's say you did have an employee, to that 401k plan, and you wanted to still do some alternative investing. The way that you have to offer that to your employees has changed a bit. Now you are automatically required to auto-enroll eligible employees at 3% or a max of 10%. So no longer do you have to wait for the employee, if you have one, to opt into the plan. You have to automatically enroll them into the plan at a 3 to a 10% excuse me, contribution rate. They can opt out of it if they'd like to. So that is something to consider in that scenario. But again, if you do have employees, you do have to consider that. Even if you only have one employee, you do have to auto enroll them if they are eligible. Another big change, which was something that kind of affected a very small percentage of people, but still really affected them, is that if you were someone that was getting towards the age of retirement, which was in this case the required minimum distribution date being 72, Roth 401ks had a required minimum distribution, which kind of caused an interesting scenario for people saying, hey, look, Roth IRAs don't have a required minimum distribution. Why do Roth 401ks? I don't know. I don't pretend to try to understand all the inner workings of why the IRS does what they do, but that was the case. So coming into this year, it was legislated in 23, but as of 24, Roth 401ks no longer have a required minimum distribution. So that is a very big benefit, especially to those of you that are interested in after-tax plans, after-tax strategies within a solo 401k no longer have a required minimum distribution on the Roth portion. Another big benefit that just came into effect this year is that sole proprietors and single member LLCs that have solo 401k plans can now make elective deferrals by the tax filing date in the subsequent year. So let me expound on that a little bit. Previously, there was really no direct information from the IRS that would say, hey, look, you've established this plan, the elective deferral, meaning what you defer out of your compensation, when exactly do you have to have that made by? They made a slight improvement under the first iteration of the Secure Act, which was the portion of tax legislation that the big chunk of tax legislation that came out of Trump's term in 2018, by saying that plans no longer had to be established within a given calendar year from 12/1 to 12/31 in order to make previous year contributions. But the elective deferral of the compensation still didn't really have any clear guidelines on how long you had to make that. The theory is that if compensation was paid in a given year, well, is deferring it in the middle of September really in best practice if it was paid last year? Again, there was kind of a float on it, and what I would typically tell clients is that by the end of January, you need to have to make at least part of that contribution. And that can be problematic for people that are self-employed individuals. You don't necessarily know how much money you made until you close out all of your accounts receivable, until you do a bunch of stuff that can really hamper your ability to effectively tax plan with these types of retirement plans. So we had a great update that came, is that saying, so long as you have the plan established within 12/1 to 12/31, you can make both parts of the contribution to the plan. So the elective deferral of your compensation and also the business match to that plan up until your extended filing deadline. Hugely simplifies things for people, gives us great clarification on exactly what the best practice is with it. Giving props, or I should say, giving congratulations where congratulations are due, maybe. The IRS really kind of did some good clarification on that. So very nice to see that now that we have some clarification, meaning that if you've established a plan, so long as it's within a given tax year, you can make your contributions well into the next year. You just have to have the plan established by 12/31. And finally, for some updates and improvements on the first part of this slide, employer and non-elective contributions can now be made on a Roth basis directly to the plan. So with 401ks, remember, we said that you have the part that you defer out of your compensation. In John's example, that was $23,000 out of that $100,000 he made. And then you also had the employer match, which was the $25,000 that we mentioned in that example. Well, previously, before this year, you had to make those contributions as the employee contribution, the $23,000, could be made pre or post tax. So that could be Roth or traditional. The other portion, which was the employer match, the business match to the plan, that always had to be made pre-tax. Now you could do an immediate conversion of it, certainly, and do the entire thing after tax, but it was a little bit cumbersome, a little bit clunky, if you will. So with the tax law updates that have now come into effect this year for 401ks, both buckets in a 401k can be made after tax into the plan. So again, nice, simplified, makes it a little bit easier to understand, especially when you talk about a plan that can, and certainly again right now is able to accept pre and post tax contributions. You can do all of that in a much more simplified, streamlined manner. Let's see, we have a question asked, do you have to have earned income in order to roll over unused 529 funds into a Roth? No. It's just if you have the unused 529 plan funds, you can then after 15 years roll them into a Roth IRA. It's not necessarily considered a contribution like you would have to have for having earned income for making that contribution to a Roth IRA. A little bit different. So great question. Okay, some additional updates that came in 2023 and 2024. Again, you have more flexibility in making elective deferrals. This again, it really only kind of comes in if you have employees, but employees can treat student loans as participation in their 401k. So if you are matching, there is a provision that would potentially make that a little bit more expensive for you as the employer, insofar as that without them actively contributing compensation to the plan, if they are paying on eligible student loans, then you would still have to match that up to a certain percentage. Again, it's unclear yet how this will play out for the sole proprietors in a single member LLC, because again, with it being one and the same, if you had student loans, you're a small business owner, a sole proprietor, would that still allow you to not participate in the elective deferral and only the and only the business plan match? Again, waiting for some additional clarification on that. And with the IRS, we might be waiting quite a long time, as we've seen by the fact that we still don't have Roth, SEP, and SIMPLE IRAs, and it's almost 2 years later. So again, something to be cognizant of. You're now able to self-certify hardship withdrawals. So especially with a solo 401k, if you have some type of hardship, you no longer have to have additional paperwork to verify or record keep with that. You can self-certify a hardship withdrawal if you need to withdraw funds from one of these plans early. And there's also a created a nationwide lost and found network to help people find old employer 401ks that are no longer in existence. I actually just ran into this with a client the other day that's looking to invest in a private stock offering. She couldn't quite track down some old 401ks. So again, some additional benefits that are being built out. However, with that lost and found system being built by the government, so I'm assuming that's probably going to take quite a while. Who knows how long that will take? But again, just some good things to understand with regard to the kind of the ecosystem in the solo 401k, SEP IRA, employer plan world that, again, might help you make a decision. Again, I really think that the additional updates that they've done to the solo 401k, specifically with the extended filing dates, the after-tax contributions for the employer match, again, some of the simplifications they've done have made the attractiveness of that plan a little bit better and a little bit less complicated. But again, at the end of the day, you really can't beat the extreme simplicity of something like a SEP. If you're someone that really just wants a tax deduction, you want it to be easy, 25% of your compensation into a plan, write it off on your taxes. It doesn't get much easier than that for a business plan. Again, you always have to keep in mind the time value of the monetary value of your time and your bandwidth. If it's going to be something that makes your life easier, maybe not necessarily from a monetary perspective, but understanding that your time has value and your bandwidth certainly does as well. Again, that's definitely something to consider. So with that said, that's pretty much the end of my presentation today. I don't like to overcomplicate it to a point, but these things can certainly be a little bit complex. So if you do have any other questions or concerns, again, feel free to reach out to us. All right, thank you very much for joining with us today, and I hope everyone has a great rest of their day.